Tuesday, May 19th. Welcome to Market Foolery. I'm Chris Hale. With me, Mr. Jason Moser. Good to see you.
Good to see you.
We've got some retail. We've got some entertainment news. We're going to start with Walmart. We're going to start with the biggest of the retailers out there. Walmart, same-store sales in the first quarter were up 10%. E-commerce sales were up 74%. They hired 200,000 workers, Jason.
A lot.
That's staggering.
It is. It is. I mean, it was a good quarter, certainly in what is a tough time. I mean, some companies are clearly, you hate to say benefiting from this, but the fact of the matter is there are some tailwinds from this that some companies benefit from, and Walmart is definitely one of them. And I think for the longest time, we saw e-commerce succeeding because of desire, right? It was people's desire to not necessarily have to go to the store and to be able to have stuff just shipped to them. I mean, now it's obviously the landscape has changed a little bit. Even pre-COVID, it was really more about becoming omni-channel. And I think that Walmart made a lot of investments, a lot of good investments to become the omni-channel. And now really that business is succeeding out of necessity, right? I mean, the landscape is considerably different. It's going to be different for some time to come. And I think this probably does shape consumer behavior to a degree going forward. I mean, we're not going to be, people aren't going to just give up going out and going shopping anymore. But it really does show that the investments in becoming an omnichannel retailer are paying off for Walmart. And just to look at some of the numbers, the top line, like you mentioned, growing almost 10% excluding currency effects. If you try to, let's put these numbers in perspective with what was going on the same quarter last year. And if we look at last year in this same quarter, the U.S. comp sales for Walmart were 3.4%, and that marked the best quarter one comp in 9 years. Okay, and this year that comp number is obviously clearly grown considerably. I mean, we're talking about a company that grew their e-commerce sales 74% this year versus 37% a year ago. Talking about Sam's Club comps up 12% versus 0.3% a year ago. So you're seeing a business that's clearly performing a lot better this year. Now, granted, there is a catalyst, there is a reason for that, but I think that success is also because of all of the investments they've been making all along the way. And if you look at the 5-year chart of the stock performance, that does make a lot of sense. That stock performance is really following along with all of the investments and the performance the business continues to chalk up.
They're not only hiring 200,000 new workers, they are also spending money expanding benefits, employee bonuses, and as we expected, costs are going up in part because they are taking extra steps to make sure that the stores are as clean as possible.
Absolutely.
You would expect that.
Yeah, you would expect that. I mean, we're seeing that across the board with big retailers. Operating expenses have gone up considerably this quarter. They're going to go up considerably here, I think, going forward. I think we are going to see the cost of doing business is just going to go up in perpetuity here. I think for retailers, for restaurants, I think any business that incorporates consumer traffic in some way, shape, or form, the cost of business is going up. I think that when I look at Walmart today, my big question, I guess, when you look at what they said in regard to this quarter, they talked about the impacts of this quarter. They use the word significantly, right? This quarter, this COVID-19 crisis is impacting their business significantly in both good ways and bad ways. Now, it's one thing to be able to serve a role as they have as a part of the greater solution, right? In being able to get consumers what they want when they want it, what they need when they need it. It's one thing to get consumers into your world and using your services, using your store once or for a period of time. It's another question entirely to get people in there and keep them in there, right? And that's what we've seen for the longest time. We've always talked about companies like Costco and Amazon doing such a good job of not only getting those customers in there, but then keeping those customers. And I think that based on the numbers that we're seeing Walmart continue to chalk up here, quarter in and quarter out, it does look like they're doing a very good job of getting customers in and then keeping them in, right? I mean, this is a big market opportunity. We're not just talking about, this new retail space being ultimately Amazon's to win or lose. I mean, as with most large market opportunities, there's room for multiple winners, and I think that Walmart is showing that they will be able to be one of the winners in the space. I think noteworthy, they're talking about the fact they are going to be essentially phasing out the Jet.com brand. And if you look back to 2016, that was an acquisition they made. It was, I think, a $3.3 billion acquisition. Most of that was cash. I think there was a little bit of Walmart equity tied to it. But generally speaking, that was just an all-cash acquisition. And I think at the time even, we recognized that was really less about the Jet brand. And it was more about getting that talent in-house to be able to build out an e-commerce operation and build out an omni-channel operation where they were having some challenges really responding to all of the lines that Amazon had been throwing down at the time. So I wouldn't read into phasing out the Jet.com brand as a failure by any stretch. I mean, I think honestly we were all just kind of expecting that to happen. It doesn't mean that what they acquired from that deal is being phased out. It ultimately just means that they've integrated that acquisition, to their satisfaction, and I think the numbers bear that out.
Last thing before we move on, I was talking to Bill Barker yesterday. We were talking about retail sort of in the wake of the JCPenney bankruptcy news. And I floated the idea that among the activity we could see in the retail industry the rest of this year and into 2021 is not just more bankruptcies of smaller retailers, but also potentially larger retailers like Target and Walmart making acquisitions either of certain brands or just retailers outright. When I look at this latest quarter from Walmart and how they are spending their money, that is clearly not top of mind for them. They are very much focused on everything they are doing with Walmart. And I don't think McMillan and his team are necessarily looking to bring anyone else in.
No, and I agree. I don't think they really need to be worried about something like that. I mean, they even mentioned on the call, they said our supply chain is amongst the most capable in the world. But even in this environment, they noted that they've stretched their supply chain. Now, I mean, I think this particular time in history, I mean, this is proving to be one of the most stressful times for supply chain management, right? For big supply chains, I think companies are getting up there and really they're having the opportunity to prove their mettle. And I think in this case, what we're seeing in a very difficult situation is that Walmart has been able to pass that test with flying colors thus far. So even you've got management acknowledging the fact that this has been a stressful environment, and they're stretching their supply chain. And you look at their physical presence, right? I mean, they definitely have one of the more compelling supply chains around the world. And I don't think they need really to make any bolt-on acquisitions to support that. I think more than anything, like the Jet.com acquisition, was represented a few years back. I mean, that was more about bringing an additional capability, a new way of looking at retail beyond just, the physical presence that they've been so successful with up until this point. Going forward, I mean, they really do seem like they have a great blueprint laid out. They were relying during the quarter in the U.S., they were rolling out that ship from store. They're temporarily right now fulfilling orders placed on Walmart.com through about 2,500 of their stores around the country. So, I mean, they have all of the pieces in place, I think, and now they have the knowledge and the expertise, in how to make all of those pieces work together and in harmony. And you got to figure if they're doing this good of a job in what is, a considerably tough time, then I think they will have a lot of lessons to take out of this, so that when things get a little bit easier, they will be one of the companies I think that'll be able to continue to sort of lead the way. Again, it's not going to be just them, right? I mean, you named off a lot of good companies, with Target and Amazon. I mean, those are companies that are going to be a part of this as well. But it's nice to see that Walmart and Doug McMillan have done such a good job, not only remaining relevant, but really helping to sort of blaze the trail for this new retail future that we're skating into.
So shares of Walmart up a little bit today on this latest report. Shares of Home Depot down a little bit. Kind of a similar story in that first quarter sales for Home Depot up 7%, but just like Walmart, they are dealing with higher costs because they are also looking to reward employees with bonuses, with higher pay, and also increased cleaning costs.
Yeah, I mean, as much as with Walmart, I mean, when we're talking about big retailers that are worthy of investment dollars, Home Depot certainly falls into that category. Again, I mean, they've had a respectable year. If you look at the last 5 years, clearly the stock has been a winner and a good one for investors. And I think that is going to continue to be the case because much like Walmart, they are doing a very good job of helping dictate, of helping shape this new retail environment. Granted, they're a little bit, I guess, more of a specialized retailer in home repair and home improvement. But still, obviously, as we've seen, that's a massive market. And so when we look to see how they've quantified those operating expenses that have hurt profitability in the near term, they quantified that to the tune of about 60 cents per share for the quarter in helping employees during this stretch and helping alter business operations and helping just deal with the general chaos that's come from this. So, operating expenses were up 17.1% for the year. I mean, you back that out and they actually brought in $2.68 earnings per share this quarter, which was really a tremendous performance in my opinion. If we look at those comp numbers, you look at total comps, they were up 6.4%. U.S. comps were up 7.5%. If you go back a year ago, those numbers were 2.5% and 3% respectively. So clearly benefiting from some of the tailwinds created by the current situation. But this was a good, I dare say, great business before this all started. And I think this is only giving them the opportunity to really prove that. And once things start to get back to normal, at least as normal as we can hope, that market is still going to exist. I mean, we're still going to have a housing market here in the United States that is aging very quickly, and a lot of these houses need home improvements. We're going to have people that have been holding houses off of the market, putting houses on the market. That's going to result in a lot of spend there as well. So again, just a business we really like here at The Fool, one that's proven itself for a long time, and you're getting $6. You're getting $6 a year just to hang on to a share of this company. It sounds like a pretty good deal to me, Chris.
It absolutely does. One thing I saw in the report that I was curious about, wanted to get your take on, was Home Depot talked about how they've canceled major promotions that they had planned, Black Friday style events. That caught my attention just because I don't think of Home Depot as a company that relies on promotion. Having said that, they are one of the steadiest advertisers across television, radio. I mean, they spend a lot of money on advertising, but I've never really thought of them as sort of an promotional event-driven business. Have you?
No, but I think that probably is just, that goes back to a point you made there, in that they do offer up such a consistent advertising experience. I mean, you always hear their commercials on the radio and you always see them on TV. And so the ubiquity there, you probably just don't even think about the fact that they're throwing in a Memorial Day weekend sale or a Black Friday sale. I mean, that's just that's language maybe they integrate into the advertisement. But yeah, they're not really dependent on that because their market, the market that they pursue is so reliable. Now, with that said, I mean, I also think a lot of these companies are probably going to be able to pull back on a lot of that promotional language in the near term, because just the fact that life is going to get back to normal in these countries or states are going to start opening their economies back up. That's going to be like promotion in and of itself, right? I mean, you don't need to add in promotional language to, spur customers to get back out there and shop and spend, because so many people are ready to get back out of their houses and just do something, shop, spend a little bit. So I think they don't have to worry so much about that, and rather, they can focus their message more around things like safety and being, part of this team. We're all in this together. You hear that a lot. I mean, and I think that they can pull back on maybe some of those, some of that promotional language affiliated with specific events or weekends, and then just focus on the greater message. And I think a lot of these retailers, in Walmart and Home Depot, you go through those earnings releases, I think they've done a very good job of incorporating all of the stakeholders in the language that they're using in these reports. I mean, they really are talking about how it's not just about business. I mean, it really does transcend business. It's about the employees. It's about the country. It's about people. And they're trying to be a part of the solution, not only on the retail side, but on the safety side, on helping everybody kind of get back up and running. And so I think the more they can focus messages around that and the less on, individual promotional stretches of time, that probably creates a little brand equity there that doesn't hurt over the long haul.
We have a new CEO for TikTok, the video company. Kevin Mayer, who was longtime executive at Disney, clearly did not get the top job when Bob Iger stepped down. Kevin Mayer was head of Disney streaming. He oversaw the acquisition of BAMTech, which is the company that makes the streaming tech that powers Disney Plus. This is a good hire by TikTok, and the first thing I thought when I saw it was, oh yeah, so TikTok is absolutely going to be going public at some point.
Yeah, they may. I mean, I guess TikTok is it's owned by a bigger company. So I mean, I don't know what the vision is there. Are you a TikTok user, Chris? I'm not a TikTok user. Are you?
I am not. They are the parent company of TikTok is a company called ByteDance, which I've seen some private market valuations for ByteDance at around $80 to $90 billion. So if those are accurate, I mean, TikTok is sort of the jewel in the portfolio for ByteDance. So yeah. It's not unreasonable to think that it could get spun out, probably not this year, but next year or the year after, at maybe somewhere in the neighborhood of $10 to $20 billion. Depending on how valuations are when it finally does go public. But no, I am not a TikTok person. I'm not the target demo for that. I don't think you are either. I think our kids are. And it's, it's interesting because the thing about TikTok, and maybe you had this same reaction the first time you saw it. My reaction when I first saw a TikTok video was, oh, it's like Vine. It's like Vine videos, which were popular and then got killed for some reason. And Kevin Mayer, look, he wasn't going to stick around at Disney. This is probably just as, not to say that this is great for Disney that he left, but he wanted the top job. He didn't get it. If you're Bob Chapek, you're probably happy for Kevin Mayer that he has found this opportunity.
Maybe so, yeah. And I mean, maybe this is a good thing ultimately for Disney because, one of the other effects of this is that Rebecca Campbell will be taking over from Mayer's position on the streaming division, and she has served as the president of the company's Disneyland Resort in California here. And so, perhaps that ultimately is a good thing as well. So congratulations to Ms. Campbell for that promotion there. I think for me, the first thing that comes to mind whenever I think about TikTok, and given that what we know about social today and how social has evolved is, this has me asking two questions. So after TikTok, what's the next big thing? Because it does feel like it's just always about what's the next big thing. And TikTok feels like the next big thing right now. And when is Facebook going to try to acquire it? Because it does feel like Facebook at least tries to acquire everything that they think is the next big thing. And, honestly, that makes sense. That's kind of what they're doing. We saw that they just acquired Giphy, which, that's not really the next big thing. There's just a money-losing GIF engine or GIF engine, however you subscribe. But I think that it's interesting to me, this line of work, this move here. We've talked a lot about Iger's replacement. and ultimately bringing Bob Chapek in. And I think they did the right thing in bringing a parks person in. And that feeling has been reinforced recently. We've been watching the Imagineering series on Disney Plus. I don't know if you've been able to see that. I highly recommend it, even if you're not, a Disney aficionado, or it's really enlightening to see how this Imagineering side of the business works, and you get some good history there too. And last a couple nights ago, we actually watched the episode that focused on the Michael Eisner years. A couple of episodes that really focused on the Michael Eisner years. It was really interesting to see how his tenure with the company unfolded, because he really had it rolling early on. Yeah, that right hand man and President Frank Wells, they were really. It seemed like they could do no wrong. And then they hit this point. Mr. Wells was unfortunately involved in a helicopter accident, and he died. Eisner started making some questionable moves, and all of these questionable moves really revolved around parks. Now, granted, they were mainly international parks, but not all of them. But ultimately, we just saw kind of as time went on, Eisner didn't really knock the ball out of the park when it came to building these parks experiences. And we know how important those parks are for the company, not only from a financial perspective, but really that's the most public reaching part of this company. That's the experience. Everything kind of flows from that parks experience. You've either been to the parks, or that's one thing you really want to do as a kid when you're growing up. And as a parent, you want to take your kids there because you want to do everything you can for your kids. So it shows how important the park system is. And I think it shows that they made a good move in bringing Chapek in. And ultimately, I think that means for Mr. Mayer that this just wasn't really going to be a place where he could advance to do ultimately what he wanted to do. TikTok seems to be certainly more in line with his skill set. So I think that's probably something that worked out well for everyone. But I really do feel like there was a neat history lesson there in that Imagineering series, going back to the Eisner years. Maybe part of that point in time helped dictate some of the decisions that were made today, steering this company forward for the next 10, 20, 30 years.
The other thing I thought of when I saw this news was about Snap, and how when Snap first went public, you and I think it's fair to say we were skeptical about Snap's prospects as a public company. It has hung in there. It's still trading for below its IPO price, but that said, it is still a $25 billion company. So it is going to be interesting to see what happens next with TikTok. Do they make some additional moves that sort of telegraph an IPO in 2021 or perhaps beyond that?
Yeah. I think with Snap, I think very much like Twitter. I mean, you're starting to see that these really aren't the greatest businesses in the world on their own. And I say that as someone, I still own, a small position in Twitter, and I've been noodling actually just kind of selling that and moving on to where I feel like maybe my investment dollars would be better served, because ultimately when it comes to this social space, it really is all about size, and it's about having as many of those platforms under your umbrella as you can. And it's not to say that what Twitter and what Snap have done up to this point, it's not to say that that's not something you want to tip your cap to, because it is. I mean, these are billion-dollar businesses, of course, but I think they have a lot of challenges in the immediate future, just based on the fact that we're always focused on what is next. And I think for Snap, you start looking at TikTok and you start wondering how much traffic is TikTok going to take away from Snap. I think that's a very similar audience there, and so. Yeah, I mean, what the future holds for those two businesses is going to be very interesting. I think Facebook is really in the catbird seat there, in that they are so big and they have so many different social platforms under their umbrella. But yeah, I'm sure that Mr. Mayer is going to have a lot of fun helping dictate TikTok's future. And I think that we're also going to see, given the questions that revolve around TikTok from a security perspective, I mean, you have to at least acknowledge the fact that there are some questions regarding security, the nature of the platform, spying and whatnot. I mean, you've seen that before, and certainly our U.S. government wanted to bring executives from TikTok to testify. And they said, sorry, we can't do that. All of our executives, don't live in the U.S. We live in China. Well, you know what? Now you're CEO. Well, you got an American CEO. So it'll be interesting to see how that unfolds. If maybe the politicians don't want to get out there and try to push these guys around a little bit in the near term, and that presents a risk as well.
Jason Moser, thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.